My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Today my special guest is David Dickson, zooming in from Cleveland, Ohio. And David comes from the corporate world, like a lot of folks do, got into real estate, and he does a bunch of different things in real estate. So David runs a brokerage. He's also a very active investor, I believe. Started off doing flips and then got into multifamily a few years ago. So he is all things real estate. We're going to take a deep dive into some of the lessons David has learned over the last 14 or so years. So David, welcome to the show.
Yeah, thank you. I appreciate it. I welcome the opportunity and whatever I can do to help engage people and support and
what it's all about.
Guidance from my experience. Happy to do so.
So David, give us a snapshot of what real estate means to you at the end of 2025 when we're recording this. What do your different real estate businesses consist of today?
So as of today, and just one correction, if you will, and that could be my fault, I do not run a brokerage. My wife is an agent with Keller Williams here in town, although she's transitioning out of that over the next 6 months to focus on more health and wellness type activity, which was what feeds her soul. So for me and for us with the flipping business, we do about 8 to 10 flips a year. We actually have a partner coming in as we speak, and which will allow us to double that number, because that is really his wheelhouse. And then with the multifamily, we currently own 173 doors in Northeast Ohio. We both, again, value add projects. That's really our focus. That's our niche. And with those, we have 2 that'll refi next year. Potentially not until the Q1 of 2027. But the goal is to go from 173 doors to about 500 doors, and preferred locally, just because resources, manageability, and things like that.
In what time frame, give or take, David, would it be ideal?
I think that's in the 2 to 3 year.
Now,
you like to feel that out with some level of organic without, forcing the issue too hard to lean out your resources.
How long were you doing flipping before you got into multifamily?
About 12 years.
Okay, so quite a
bit. There's a lot of guys I know that have transitioned much faster.
But now you're doing both.
Mm-hmm.
Tell me what attracted you to getting into multifamily in addition to flipping.
Yeah, fair point. So that's more the buy and hold product. For us, we're very city engaged in community where a lot of the cities, they don't want single family homes as rentals. They want those as home ownership for care purposes and other things. So we stayed away from that, and we really focused on the buy and hold product to be multifamily.
Okay, that makes sense. Now, it's a big switch going from flipping single family homes to finding, underwriting, fixing, managing multifamily properties. What are some of the skill sets that you brought from flipping into multifamily, David?
I think that a level of communication and understanding of the financial side of things and the physical too. It wasn't my background prior, coming from manufacturing sales, but after about 12 years of flipping, I felt very comfortable with my knowledge, and I'm blessed to have. I've got some builders and developers that are friends, so I'm blessed to be able to, if I run into a challenge that I'm not comfortable with, I have people to lean on. And it's the managerial side of it, for sure.
Okay, very cool. So based on your experience with multifamily over the last couple of years, moving ahead, what are you looking for? What's your buy box? What's kind of the ideal property multifamily-wise for you guys?
Yeah, excellent question. So I think, and I would expect a lot of people to answer this way in a sense of the late 90s, early 2000s buildings, especially like for us. I can be in Columbus in 2 hours, and that is a growing market. Every 10 to 15 years, it goes through a swell. And they have a lot more young inventory. When I say that 25 years or so or less, So what I like about buildings like that is the comparability to the new product that's coming out, where you can take on an asset and, yeah, you're going to do some cosmetic renovations. You shouldn't have any major structural things. So you're doing cosmetics and then also adding some amenities, because that's a big push right now in multifamily, where it's not so much how big the units are and things like that. It's what ancillary or extra services and
Like what, for example? What would be some examples of amenities you guys have?
Yeah, believe it or not, still swimming pools a little bit, but it's more things like dog park, coffee shops that are close by, might not be on site, but workout rooms, places where you can entertain guests. Playgrounds get a little dicey with insurance and things like that. But
so what have been some examples? Maybe walk us through one of your multifamily deals. Kind of give us the before, the during, and the after, if it's all kind of up to speed now.
Yeah, fair point. So we have a 96 unit in Garfield Heights. It's right across the street from a hospital system, Cleveland Clinic, which is obviously big nationally, but certainly here in town. That is a 3.1 acre parcel with 12 buildings, 8 units per building, built in the 60s, that very traditional garden style apartment complex. The nice thing about that building, and where we're able to actually compete a little bit there, is it had a pool in the 70s and 80s, which has since been filled in. But that's our last thing that we're going to tackle here in the spring, is converting that to the welcome center. So the office will be in the old pool house, and then the old pool deck will be outdoor seating and things like that. And that's something that the competition in that market, that sub-market, they don't have it. So we do feel that that'll take us above and beyond what's around us. So,
and have you done anything renovation-wise with the property to date?
Yeah. Asphalt was redone. We've mechanical-wise, 6 boilers, 7 hot water tanks, 6 other roofs have been done. We've renovated 72 of the 96 units so far, a little slower than we would have hoped. That also has to do with cycle time, because that property came with tenants that were under subsidy programs.
Okay.
And which personally, again, I'm not judging anybody for it, but personally, I don't want that in my life, just because of what comes with it. And again, that's personal preference. So we want market rate housing in all of our properties.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. Okay, cool. So based on the work that you've done to date, has that caused an uptick in the value of the property?
Yeah, we actually, and I confirmed a couple of things this morning, because just anticipating a question like that. So we've actually increased our income $205 per door per month.
Wow. That's amazing.
And that's the gross income. That's not net, because our expenses are up a bit, just because we earmark things like structural reserves and things like that the seller didn't. But, and we probably have another $60 to $70 per door that we can capture over the next year. So, yeah, we're really excited.
Help me with the math. What kind of an impact has that had on the value of that property?
So, generally speaking, and from memory here, we bought that building for $5.3 million, and the stabilized value was projecting to be about 9.8.
Wow. Nice. Congratulations.
But it's a heavy lift too. We'll end up around 1.7, 1.6, 1.7 in renovations. So
right, over time. Yeah, makes sense. Okay, cool. So based on what you've learned getting into multifamily, kind of compare and contrast the pros and cons of multifamily with flipping, because you're now intimately familiar with both strategies.
Yeah, the biggest difference is, do you want to chase that? And I'm just throwing random numbers out when it comes to flipping, because we run a 70% model, which produces 20% margins. So do you want to chase that, selling houses in Northeast Ohio around 250? Do you want to chase that $50,000 and cha-ching, 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 or at $125 per door per month after stabilization, do you want that to come every month with less energy? Understanding that that doesn't happen in 6 months, that is the 3.5 to 4 year plan. But I think that's the biggest difference. It's a cash versus the short-term play versus a long-term for sure.
Yeah, it's big chunks of cash on a sporadic basis doing flipping versus smaller, steady eddy cash flow from multifamily. But you've also illustrated the upside potential of an apartment building can be huge. You can be talking about millions of dollars of increased value in that property when you optimize it, when you bring it up to snuff. That's pretty huge when it comes to net worth, right? The challenge with flipping is you're not really creating much net worth because it's in and out. But with this, that's the long-term play and that steady eddy cash flow down the line. Now, the other question I got for you, David, because big differences here, financing your deals. So a lot of flippers are using hard money lenders to do their deals, and they can, if they've been doing it as long as you guys have been doing it, probably they're able to get in with very little money out of their own pocket, get everything flipped, get everything turned around in 4 or 5 months kind of thing, get the product out the door. So that's one kind of financing. And then multifamily is a completely different kettle of fish there. So what have been your takeaways from this new kind of financing that you're involved in?
Yeah. So, there's a biggest difference, which, for us, we're blessed as starting in my late 30s, early 40s, it was friends that had moved from job to job. So now they've got money that's rolled into a self-directed IRA, which is the bulk of our investors use their self-directed. We do have some cash investors too, but, with the houses, I can turn a dozen houses in a year with about $1 million and $1.5 million to cycle through in this market. That's one building. Because generally, the summary of the financials on a building is the bank will finance 65%, and we have to bring 35% to the table at closing. So that's where for us, we were floating around with about $2.5 million of our friends and family in private capital. And, we see every marketing for hard money lenders or hybrids, that the pricing has actually come down, quite a bit for lenders with the different entities that have been created. So I do see opportunities out there at 10, 12%. We pay our guys 10% on their funds. So the one kicker for them on the buildings is they do get that 10% during stabilization, but they get an equity piece in perpetuity. So as long as we own the building,
that's pretty sweet.
They already have the principal back to refi, and then they get a.
Well, so that's really smart, David. So you're not really doing apples. Well, it is apples to oranges, the asset class and everything, but you're keeping the returns very similar. So from your investor's perspective, it's not like a huge difference. I guess the only difference would be if with the flips, if it's 10% annualized or if it's per deal. How do you typically do it?
It is annualized.
Yeah, so then it's the same thing, basically.
We set a minimum. Yeah, we set a minimum for returns because we've only done it a couple times. So we've done some hoteling type, whatever you call it, and we've also wholesaled a couple over the years where we just give them 3% minimum on deals like that. But yeah, everything's annualized when it comes to interest rates.
Yeah, that's smart
to people. So
yeah, very, very smart. Very cool. So now that we're at the time we're recording this, it's the end of 2025. Well, what do you got in the works for 2026? Where do you see yourself taking the businesses? You got the flipping.
Yeah, so
you got the partner coming on. Yeah.
And the nice thing about that is it allows us actually to physically shift because we need to. Cleveland is heavily saturated, in some of the major cities some of the good sized cities in the Midwest are because our housing stock is so cheap. Right. Our barrier of entry is very low compared to other parts of the country where you can get quality good returns, mid double digit returns on long-term rentals. Well, a lot of our housing stock around Cleveland is getting sucked up by, the rental investors. And so we're actually going to shift some of our activity further south, which coincidentally, that is actually where he lives. So it works out really well. The timing is just really nice for that. So it's increasing the volume that we're doing there. We've already started shifting our marketing so that we're sending direct mail and things like that. So we'll start seeing some of that activity come back in Q4 here. And with the buildings, I anticipate starting to pursue additional, because even the Fed cut the rate a quarter today. So I do anticipate that activity getting a little heavier in the spring. I've already talked to brokers. They know I have built some relationships there, so they know what we're prepping for. So I do anticipate pursuing some additional properties in late Q1 or late Q2 next year for the lawsuit.
David, if people want to connect with you and find out more about what you're up to, where should they go?
Yeah, easiest thing would be cpdhomes.com. And that's, that'll link to everything that we're doing, whether it's social media, other social media platforms and things like that. So making on stuff. So because that's the one message I would want to give to any of your audience is I'm an open book. If you want to reach out, you need help with something, I can't promise the world to everybody all the time. I can't do that. But I do believe that we're in a space that good people should and be willing to and able to help other good people. So
wonderful. Well said. David, congratulations on all your success. I wish you much continued success, and thanks for being on the show.
Okay, sounds good. I appreciate it.
All right, everybody, take care. We'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.